All right, guys, welcome to class 5 of the day trade course. This has obviously been, the last 4 days have been all about building your foundation as a trader. So in class 2, we talked about risk management. Class 3 was stock selection. And class 4 was breaking down our daily charts. Now, we're going to continue to build on the foundation we've already set, but we're going to dive in a little bit deeper into the daily charts and into charts specifically. So today we're going to start talking about the intraday chart patterns. So focusing in, and we'll be looking at the 5-minute time frame and the 1-minute time frame. As you guys already know, you've learned how to manage risk on your trades, how every trade needs to have a 2-to-1 profit-loss ratio in order to justify taking it. And with a 2-to-1 profit-loss ratio, if your accuracy is 50%, you will be profitable. Now, we've also learned how to find the right stocks to trade. We broke down the 6 criteria of stocks with home run potential, and today was a good example of me trading stocks with home run potential. I'm finishing the day with $6,417.92 in my $105,000 account. So today's a day my account grew by over 6%, and it is thanks to trading the right type of stocks to trade. Stocks with low float, high relative volume, great daily chart, history being a former runner, and ideally a strong catalyst. Now, in our last class that we had on Thursday, for those of you who have been watching these classes live, we talked about breaking down the daily charts, how to find those pockets of no resistance where we could potentially get large breakouts. So the importance of being above the 200 moving average, the positioning of our moving averages, and the significance of those large gaps and windows formed by either long body candles or gaps. So today we're going to begin to dig into the chart patterns that are going to become part of the trading strategies discussed in our upcoming classes. Now, class 6, which is coming up, of course, next, is going to be one of the longest classes of this entire course. It will be split into several parts, just like class in chapter 4 was, but just to prepare you, it will go in depth. And so today is sort of setting the framework for what we'll be discussing in class 6. And also just kind of a quick look at what we've already covered and a look of what's coming. So we've gone through chapters 1 through 4 right here, as you can see. Today we're on chapter 5, and coming soon is chapter 6, 7, and 8. These are strategy development classes where I'll be breaking down the strategies that I trade every single day on momentum stocks, reversal setups, and then parabolic stocks. These will all include live trading examples where you can see me actually trading with my own money. Chapter 9 is when we'll get into stock scanning, and that's when I'll provide scanner settings for you guys, the same settings that I use on my scanners every single day. Chapter 10, we'll get into level 2 tape reading, and that's when I'll share my hotkeys with you guys, and then we'll continue on chapter 11, 12, 13, 14, and 15. All right, so a little bit of a look back and a look forward. So today you will learn the most popular chart patterns. Now, the fact is, chart patterns work because thousands and thousands and thousands, maybe even millions of traders are respecting them. These are a universal language. It crosses cultural, regional divides because anyone who trades the market, regardless of their culture, their language, they will look for these types of patterns. These patterns to traders represent an opportunity to get into a strong stock with the lowest risk possible. That's what the pattern is, right? Yesterday or in class 5, we talked about how patterns are helping us predict with as much certainty as is possible in the stock market the near future price action. Okay, but remember, these patterns are only worth applying and looking for on the right type of stocks to trade. So you don't try to find these types of patterns on stocks with really, really low volume, or on stocks with extremely high floats, like a Bank of America with a 10 billion share float, or even an AMD with an 800 million share float is usually not going to be the type of stock we would try to apply these patterns on. we're going to continue to look for stocks that meet our criteria for being the right type of stocks to play. Those are the type of stocks that we want to trade, and so we're going to use these patterns to find our entries. Okay, now I also want to remind you that what we're going to look at today are simply patterns. These are not strategies. You develop strategies around patterns, but a strategy also includes the type of stock you trade, the time of day you trade, your max loss, your profit target, your share size. A strategy is a comprehensive approach to how you trade the market with a set of rules. A pattern is simply a pattern that we observe. So today we're going to talk about being able to observe these patterns, understand the anatomy of these patterns, and then in class 6, I'll be bringing in the strategy for how we'll trade these patterns. Okay, this is obviously important because chart patterns are what we use to establish entry points and profit potential. It would be impossible for me to trade without charts or without chart patterns. Okay, so it's also worth noting that when you look at charts, it's important to start to develop a frame of mind of what would someone who's currently short this stock be thinking about this chart pattern. Would they be thinking this is, I'm short and I'm going to need to cover if this goes above this level? Where would they be setting their stops? Remember that the market is so much driven by collective trading mentality and by those emotions of fear and greed. So if we can start to get in the minds of traders on the opposite side, we can predict when they would be bailing out. When a trader who's short is bailing out, he's a buyer, and that'll create a spike in buying. So if there's an obvious place on the chart based on a pattern where anyone who's short will get out, that's a place we should be especially mindful of and keep a close eye on. All right. So intraday charts versus daily charts. Now, remember from class yesterday that, or class 5, that when we have a super strong stock with a really good catalyst and it just meets all of our criteria for being the right stock, it can override a poor daily chart. However, a great daily chart will never override a poor intraday chart. So we always, for every single trade we take, we need an intraday chart because that's how we manage and establish our risk level and our profit targets. That's a must. So intraday charts are a must, but the daily charts are preferred. But if we don't have them because for whatever reason the stock is below some of its moving averages or right at a resistance point, that might be okay as long as we have the strong intraday catalyst. But again, we're always going to focus on the stocks that are in play, meaning they have high relative volume. So if you're looking to try to see these patterns, in real time, or you're looking in the evening at various stocks, make sure you're looking at the right type of stocks. Okay, so all of the charts that you'll see today had or have strong daily charts as per the class yesterday. All right, so when we're looking at these good intraday charts, know that they are in the context of a daily chart where the price action supports a big move, whether it's up to the next gap or up to the top of a window or with lots of room up to the 200 moving average. And another reminder that volume makes the pattern. What is volume in the context of a pattern? Volume is confirmation. When you have a pattern and you expect it to break at X point and you have lots of volume coming in, that volume is other traders, real traders executing orders because they see what you see, right? So they recognize the same opportunity to get in a strong stock or the same opportunity to get out of a short position with a minimal loss. So when we see volume at the breakout spot, it's confirmation that we're, number one, trading the right type of stock, and number two, that we identified the pattern correctly. And for that reason, when I'm trading, as soon as I get into a trade, I'm expecting almost immediate volume, and I'm expecting to be right and profitable on the trade really just within a few minutes. So if I get into a trade and I'm break even for 2, 3, 4 minutes, it tells me that I was wrong about that being the breakout spot. We didn't get volume there. Now, I've had a lot of students ask me questions about should I use the 1 minute time frame or should I use the 5 minute time frame, and which time frame are we going to apply these patterns to? Well, the reality is these patterns exist on all time frames: 1 minute, 5 minute, 15 minute, 60 minute, and daily, and of course all the time frames in between. However, the 5 minute time frame is the most respected by day traders, and then the 1 minute time frame is very closely behind that. So the 1 minute and the time frame are the two time frames that we're going to study. Now, if you have a bull flag pattern on the 5 minute chart, the odds are that the 1 minute chart will also support what you're seeing on the 5 minute, because of course that pattern on the 5 minute is built of 1 minute candles. So they should more or less match up, and you'll have pretty good alignment across those two time frames. So when you start with the bigger time frame and you go down, it's usually where you get that confirmation. You have a good daily chart, then you look at the 60 minute. You've got a good 60 minute, you look at the 15 minute, which is probably going to be good. And then the 5 minute is probably going to be good. And then the 1 minute is probably going to be good. If you start with the 1 minute, that doesn't guarantee by any means that the 5 minute is going to be good. A good pattern on the 1 minute will sometimes on the 5 minute look like a stock that's really, really extended. So for that reason, I always suggest that beginner traders focus on the 5 minute time frame, because it's just so well respected, and for the most part, you know that the 5 minute will also have a good 1 minute setup. So traders who do trade primarily the 1 minute will still take that 5 minute setup because it's aligning with a 1 minute setup. But if you trade just the 1 minute, you have to make sure you check the 5 minute to confirm that there's not a contradiction. Where you have a long signal on the 1 minute, you could potentially have a red flag or a warning on the 5 minute. And if that's the case, you won't have as good of resolution, because some traders will recognize that, and as a result, they won't take the trade. I see that that was covering this just a little bit, but let's see. I'll just jump forward here. And I'll make that a little bit smaller for the next one. Okay, so there we go. So what I said there is the first 1 minute pullback after a 5 minute breakout is particularly strong, because this is where traders who missed the initial entry will get in. And I'll show you lots of examples of that, but that is a really one of my preferred patterns. So when a stock has the 5 minute breakout and it starts to squeeze up, some traders will look at that and they'll say, oh my gosh, it's the 5 minute is going and I just missed it. Well, I'll get in on the first 1 minute bull flag. Now that little mini 1 minute bull flag is occurring in the context of a 5 minute breakout, which is just beginning. So since the 5 minute breakout has just started, the first 1 minute pullback is worth taking, and you get in there. And if it continues, then you just have a continued 5 minute breakout, which just continues moving up. I will trade the first 1 minute pullback after every fresh 5 minute breakout. So when we're watching the 5 minute chart, we see it move up and then we pull back, we get in for 5 minute breakout number one. We see it move up, little 1 minute pullback, we get in here. Second little 1 minute pullback, we get in here. I'll trade the first one, I'll trade the second one, I won't trade the third one. By the time we're at the third one, the 5 minute chart is already going to be too extended. So now I need to wait for the 5 minute to pull back and set up again. Let it pull back, and then as the 5 minute starts to break out a second time, I will get in both for the second 5 minute breakout and now for the 1 minute pullback out of that fresh breakout. So just the way I only trade the first two pullbacks on the 1 minute chart for each 5 minute breakout, I will only trade the first two 5 minute pullbacks, because on a 15-minute chart or a larger time frame, when you're starting to look at the third 5 minute pullback, the stock is going to look really extended. So word to the wise, only trade the first and second pullbacks, whether you're using the 1 minute time frame or the 5 minute time frame. So first pullback is fine. Second pullback is fine. After that, you need to wait for a period of consolidation for the stock to flatten out and rest before it makes a new move. And I'll give you lots of examples of that, but just to Um, just to say that before we get in. So when we talk about the 1 minute versus the 5 minute time frame, these are some circumstances where I would not use the 1 minute chart. Number one, if the stock is extremely extended already on the 5 minute chart, right? If it's really extended, I wouldn't trade I wouldn't trade the 1 minute setup. Number two, if the stock has already experienced more than two pullbacks on the 1 minute time frame since the breakout began, right? If we're coming up to our third pullback, I'm not going to trade it. I'm going to wait for a 5 minute consolidation. In other words, it's most likely extended on the 5 minute chart and needs a pullback to give us a second 5 minute bull flag or flat top pattern. Number three, I'm less likely to use the 1 minute chart on higher price stocks over $10 and especially over $20. This price range gets very choppy with lots of fake outs. So we might see a 1 minute setup, and it's not uncommon to see it break by 20 cents and then drop 40 cents. And it happens so quickly, you don't have time to get out with profit, and next thing you know, you're down 40 cents. Number four, if the 1 minute chart is extremely extended off the 20 exponential moving average, I'll always be more cautious, even though I might still take the trade. I prefer to take trades when the 1 minute chart is near the 20 moving average because that would be a pullback entry, a nice clean pullback on the 1 minute. And number five, I rarely take a 1 minute entry if the 1 minute price is below the 1 minute 20 EMA. Again, I'm going to show you examples of this, and I can jump forward here and just show you one example really quickly. Let's see. So I just want to make sure you're able to picture what I'm saying here. All right, so this, of course, is our first 5 minute pullback. So, of course, I would trade this situation. This is our first 5 minute pullback. I would trade here. This is our first 5 minute pullback. I would trade here as well. This is our first 5 minute pullback. I would trade here as well. This shows the first 5 minute pullback and the second 5 minute pullback both working. And by the third, it's too extended. Now think about if it's this extended on the 5 minute chart, on a bigger time frame like the 15-minute, it would just be like a straight up candle. It would be very, very extended. And now here we see a 5 minute time frame and the 1 minute of the same chart side by side. Okay, so this is what I meant here where this is the first 5 minute breakout right here, the first 5 minute pullback. We squeeze up, we pull back, and this would be an entry. We start to move up. Now in the 5 minute time frame, you could get in here and just hold it until you hit your profit target. But what if you missed that breakout? The proper entry was here at like 317. What if you missed that entry? A lot of traders will, just because of, we miss trades sometimes. And so we would buy the first 1 minute pullback, which is right here. This is the 1 minute pullback after the fresh 5 minute breakout. So I would buy right here. And then we start to pop up. Okay, we squeeze up, and note that this is our 20 moving average on the 1 minute. So this is a nice safe entry, pretty close to the 20. Now it squeezes up here, and that gives us the resolution, and then it pulls back. Now I wouldn't get in here because now at this point we're a little too extended we're starting to get more extended on the 5 minute, and we of course just had this kind of big red candle, so we let it consolidate and get closer to the 20 moving average. We want to see 1, 2, 3 candles, 2 or 3 candles of sideways consolidation. Then the first candle to make a new high on the 5 minute time frame is our entry here. It pops up and we missed it again. Let's just say, for example, it pulls back here, and now you buy the first 1 minute pullback, which is right here, after the fresh 5 minute breakout. And in this case, you got in here, and you could still get profit up to here. Now this pulls back again. Of course, by this time, it's getting more extended on the 5 minute chart. You let it pull back and consolidate. All right, so this kind of showing you that you can trade only on the 5-minute time frame where you're not even looking at the 1 minute. But then if you miss your entry, you just basically have to wait through this whole squeeze for the next pullback. So if you miss your entry, you could refer back to the 1 minute and say, okay, it just started to break out on the 5 minute. I'll wait for that same bull flag pattern to occur on the 1 minute time frame on the first pullback. The first and second pullback are always the safest. As you get more extended, the risk really increases. All right, so let's back up here to the circumstances where I would not use the 5-minute time frame. Okay, so does that make sense to you guys? I want to make sure that you understand this because there's been a lot of traders who will ask me whether or not they should be using the 5-minute or the 1 minute. Now, as an example here, circumstances where I'm very likely to use the 1-minute time frame. When a stock meets all of our criteria for being a stock with big potential, low float, huge volume spike, great daily chart, etc., and it has just hit my high day scanner, I may look for the first 1-minute pullback, even if it's a very small micro pullback, simply because it's such a strong stock. And if I wait for the first 5-minute pullback, by that time I might miss a good portion of the move. So that's time where instead I'll look for a 1-minute bull flag. So if a stock hits my high day scanner, meets all of my criteria, and the 5-minute chart is not a bull flag, it's not set up, it's just kind of starting to squeeze up, I would basically consider that the first breakout. This is experiencing the first 5-minute breakout. So when I look at the 1-minute chart, right now, would I be able to buy the first 1-minute pullback? Now, it's possible I already missed the first 1-minute pullback. It already has moved up, pulled back, moved up a second time, and we're on the second pullback. And if that's the case, just for whatever reason, that by the time it hit the scanner or by the time I saw it, it had already made that much of a move, then I would say, okay, in this case, I have to just wait for the first 5-minute pullback because it's too extended. But if the stock hits the scanner, it pops up, and it's early into the first 5-minute breakout, that's when I would say, okay, I'm going to wait for that 1-minute pullback. Now, that's the reason I got into some of the stocks I traded last week and even today, which I'll show you in just a moment when I start giving you kind of the breakdown of some of these patterns. Okay, so circumstances where I'm likely to use the 1-minute time frame. Stock starts squeezing right away. I look at it. I realize it has big potential, which means I want to get in it as quickly as possible, which means I will buy a pattern forming on the 1-minute time frame. Of course, I would only be doing that for stocks under $10 that meet all my criteria for having big potential. Second circumstance where I'm likely to use the 1-minute time frame. When a stock meets all of my criteria and has just broken out of a 5-minute chart, but I missed my entry. So it just had the first 5-minute candle to make a new high. And yes, I would have loved to have gotten in at the right spot, but I just missed it. Two options. Option number one is I wait for the second 5-minute pullback. So that means it might run, from $3 up to $4, and then I have to wait for the pullback under $4. So in that move from 3 to 4, I'm going to miss the whole thing. Option number two is that I buy the first 1-minute pullback after that fresh breakout, knowing that I'm not the only trader who missed my opportunity. And also knowing that someone who's short might say, okay, it popped up, I'll let it pull back for a second. I think it's going to be a fake out and it's going to drop all the way back down. But if it goes back up through high day, that's when I'll get out. And when you combine those types of traders who are short and kind of holding and hoping, plus a trader like myself who missed the first proper entry, that first 1-minute pullback will almost always get good resolution as long as you're looking at the right type of stock. Okay, so that might all sound a little bit confusing, and I know that this is a little bit more, a little more intricate, but I want to make sure I give you these details. If you have to watch this a couple of times for it to soak in, that's fine. But these are the things that I'm thinking about when I'm getting ready to take a trade. And when I'm saying, should I trade the 1-minute or should I trade the 5-minute? So remember, as a beginner trader, the 5-minute chart will almost always be cleaner, meaning the resolution will be better because more traders are watching it, and that means more buying volume. The patterns take longer to form, which means it's less likely you'll miss them. But at the same time, between 1 minute pullbacks and 1 minute bull flags, a stock can run 30, 40, 50, or even 100% without pulling back on the 5 minute time frame. So by waiting for the 5 minute chart to set up, you will miss some setups. So today we're going to be reviewing my favorite patterns. Now, these are valid both for long traders and short traders. The long side, of course, would be inverted for short bias traders. So we're going to look at bull flags to the long side and bear flags to the short side. Flat top breakouts to the long side, flat bottom breakdowns to the short side. Flag patterns above moving averages, pull back to moving averages, and flag patterns below moving averages, a pop up to the moving average for a fade. And then number 4 is the 1, 2, 3, 4, also known as the ABCD pattern. And again, reminder that these patterns are by themselves just patterns. They're not a trading strategy. These are a component to the trading strategies we'll be talking about in class 6 and 7 and 8. All right, so these patterns can occur on all time frames, but as day traders, we're focused primarily on the 5 minute and the 1 minute time frame. So pattern number 1 is the bull flag, and the inverse is the bear flag. So the bull flag is when you have a stock that quickly surges up. It moves up really quickly, and what happens oftentimes after a stock makes a really quick move up? There's a moment of pullback. So in that pullback, there's a little bit of distribution where traders are taking profits. You know, they just got a big spike, they're taking a little bit of profit off the table, and it just kind of pulls back for a moment. If the stock is truly strong, traders who want to get in will see that pullback as an opportunity to buy a strong stock at a little bit of a discount because it just pulled back in price. And they buy that first dip as it surges back up through the high. They're accumulating shares and it's squeezing up. A volume profile is part of the bull flag pattern. That means there'll be big volume on the candle that spikes up, lighter volume on the pullback. The light volume on the pullback tells you it's just a little bit of profit taking and not a lot of people shorting the stock with big size. Sometimes you'll see light volume on the spike and then huge volume on the sell-off, which tells you that traders are shorting the pop. That's not what we want to see as a long bias trader. We want to see that the volume is weighted more heavily towards the buyers. So a big green candle, big green volume. A couple candles of pullback, and then the first candle to make a new high, we need to see volume increasing because that shows us that fresh traders are coming into the stock wanting to get a piece of the action. So the bull flag pattern and the bear flag is inverse. A bull flag consists of the following characteristics. Number 1, it can be as little as one candle moving up sharply, but it's often 3 or more candles moving up. 3 green candles forms the flag pole. Okay, so that's the flag pole, and then the flag is that little pennant shape, that little triangle of sideways price action. Okay, we want ideally 1, 2, or more red candles of sideways price action, and we don't want any of those candles to break the previous candle's high. So they keep forming lower lows. They keep dipping down just a little bit for 1 or 2 or 3, sometimes 4 candles. If it's only one candle that's red and then we go right back to moving up, that's like a micro pullback. It's not a very well-formed pullback, which makes it harder to really understand our max loss. Just because the stock showed that it dipped down on that red candle and then all of a sudden squeezing back up, there's a big range there. We'd prefer to see that range consolidate as the candles become smaller, and then the first candle to make the new high is our entry point. And that's what we would call the apex point. And I'll show you that in of course, examples in just a moment. Now the perfect 5-minute bull flag pulls back to the 9 exponential moving average. That exponential moving average is moving up on the 5-minute chart. It pulls back right to it, it taps that support level, and long bias traders recognize that and again see that as a strong entry point because you're buying at support. You always want to buy a strong stock at support. Okay, so a bull flag. three, as little as one candle, but could be three or more candles moving up, forming the pole, and then one, two, sometimes three or four red candles, and then the first candle to make the new high is the entry point. Remember that I only trade the first and the second bull flag on any breakout. After that, the stock needs to pull back for a period of consolidation. So this right here is an example of a longer flagpole. You have four big green candles and you had three smaller ones before that. So this is technically 7 green candles in a row. And then we have one red candle and we have two. And now we have this third candle here, which happens to be green, which is okay, but it didn't break the high of the previous candle, which is right here. And note that we come right over to the support of our 9 moving average. So when you see this pattern, where would your entry point be? Let's say the price of this candle is 370. The high is 370. That is your entry point. As soon as this green candle breaks the high of 370, I would be a buyer. Now, if I'm watching the level 2 and I see a lot of buyers accumulating around 368, 369, I may just go ahead and press my order to buy a half-size position as I see that volume coming in, because I'm anticipating that we will break the previous candle's high. And if we do, our first target is high of day right here. Okay, so this right here is a bull flag. The entry is the first candle to make a new high, which was 370. Target was high of day. So from 370 up to $4, that's 30 cents. If this goes up 37 cents, we'll make 10%. And this goes up to a high of 420. That's a 10% move right here. Now, if you put a quarter, or if you put half of your account into this stock, your account would grow by 5% just in that move. So I'm just looking at your question there. The first one, Joanne, so if no bull flag or flat top breakout, no buy. And yes, that's essentially correct. I need to have this pullback because this is how I establish an entry point that has low risk. If I bought this, Sam, up here, if I entered, way up here after 6 consecutive green candles, what's my stop? I mean, my stop could be the low of the last candle, but I'm getting really extended. If my stop was the 20 moving average, it's really far away. Now, we're looking at the 5-minute time frame on this stock. This stock may have very likely given us a 1-minute bull flag that looked just like this inside this candle here. And that would have been our entry. Let's see, this was a while ago, so I'm not going to be able to go back on the 1-minute chart that far to see it. But it's very possible that this would have given us a 1-minute entry early in the move. So we probably could have traded it already once early in here. See how this has this upper high? What that tells me is that the candle squeezed up and pulled back. So did it squeeze up, pulling back, forming a bull flag, kind of like this? It's possible. And then we could have maybe had an entry around 320. So it's definitely possible that there was a 1-minute setup right here. And I would have been okay with taking that 1-minute setup because the stock basically was just experiencing a strong surge of volume. So the first 1-minute pullback is fine. And then the first 5-minute pullback, of course, is fine. All right. This is the type of pattern we look for every single day. Here's another stock, AKER. So this stock right out of the gates squeezed up. Now this was not a gapping stock. It wasn't gapping higher. It just all of a sudden the market opened and it squeezed up from 210 all the way to 250. I mean, that's a pretty big squeeze. And then it went all the way up to $3. I mean, it basically just opened and squeezed up 50%. So although there may have been, again, on this stock, a 1-minute pullback right in here, this just happens to be the screenshot I grabbed of the first 5-minute setup. So you may have been able to trade a 1-minute pullback, a 1-minute bull flag in here. This pattern is valid whether it's occurring on the 5-minute or the 1-minute. So yes, right here it says 5-minute, but if this said 1-minute, I would still be trading the setup. It would just be earlier in the day. And we would be like, yes, this was the first 1-minute pullback on a strong stock. But this happens to be the 5-minute chart. So we get the 5-minute candle up. we've got the flag forming, and now we have one candle of pullback, two, three candles of pullback. The first candle to make the new high is the entry. We don't wait for this candle to close, right, before we get in. The candle closed all the way up at 305. As soon as it crosses the trigger price is the high of this last candle. And remember that as these candles are pulling back, when this candle was forming right here, we would have been looking at this candle and said, okay, the high of this candle is 380, so our trigger is 380. But as soon as this candle closed and didn't break 380, 380 is no longer in play. Now we're looking at the high of this candle. All right, so as this candle broke that high, that was our trigger. We got in, this would have been around 375, and we squeezed up to a high of 320. Again, entry was 275, squeezing up to a high of 320. That's nearly a 20% move right here in this one pattern. And Arthur, to answer your question, it's a mental trigger in the sense that you're looking at the chart and this is the place where you draw the line for your entry point. So you look at this and you say, okay, my entry point is here because that's the first candle to make a new high. And then you manually prepare the order, which I'll show you more in class 6. But right now, I just want you to understand the pattern. Now, the proper stop on these can be, one of two setups. Your stop can either be the low of the trigger candle, and that's the stop that is the most illogical, but I often set stops closer to my entry price. Instead of having a 25 or 30 cent stop, because that's how big that candle was, I'll set a stop at 10, 15, or maybe 20 cents, because I figure if I get in and it drops 20 cents, obviously I wasn't right about that being the apex point. So I'd rather just get out than hold on to it as it continues to drop. So minimizing the loss. This is a stock here that was a little bit higher price, and this makes it especially important to use the 5-minute time frame instead of the 1 minute. Right as soon as the market opened, it squeezed up from $24 to $25.80, and then we pulled back. We've got one candle of pullback and a second candle of pullback. The first candle to make a new high was right here, and as we broke 25.35, we squeezed up to a high of 26. Note that this was a little extended off of our 9 moving average right here, but it was right at the VWAP, the volume weighted average price. So it did have a little bit of support there, but it was a little extended, which made this trade a little riskier. This right here is a great 5-minute setup. The stock squeezed from $6 all the way up to $8.50, over $8.50. I mean, that's a huge move, right? I mean, it's 30% move in 20 minutes. Now, when I saw that move, I was like, okay, I want to get in this stock, but I need to wait for a pullback. I can't buy a stock at $8 that was at $6 15 minutes ago until it's consolidated. I let it pull back here for 1, 2, and 3 candles, and I was watching the high of each of these candles. The high of this candle was 8.10, and I was watching the high. The high of this candle was like 8.09, and I was watching it. As soon as this candle opened, we broke over 8.10, I jumped in, and we popped up all the way to 9.39. 10% move in 5 minutes. Right there. That was how I made on that one trade $4,746. Entry here for the first 5-minute candle to make a new high, selling through the highs. Now, I wouldn't say this is a flat top pattern, even though these two candles have the same high. A flat top needs to have ideally 3 taps at the same price. So if we had a third candle at the same price, it would start to be looking like a flat top, but this wasn't quite it. It was still a little bit of a bull flag. So this is the flagpole squeezing up, a couple of candles of pullback, first candle to make a new high versus the high of the previous candle is the entry. Here's this stock cool that I'll show you both the 1 minute, the 5-minute first, and then the 1 minute and the 5-minute side by side. So first, this is strong out of the gates, pulls back, consolidates, and then all of a sudden it kind of squeezes up here. Now, I don't know if I would have been able to get in this trade. Maybe, let's see. This was where it squeezed up suddenly at 11:30, and there wasn't really an opportunity to get in here because it just kind of squeezed up. So then it starts to pull back and consolidate. We pull back, we pop up, we pull back, and now we're holding support at the 20 exponential moving average on the 1 minute time frame. We pull back over to the 9, so our entry is the first 5 minute candle to make a new high, which right here was like 315. My stop could be $3, the low of this candle, which is 15 cents. So that stop makes sense both on the chart and it's not too big of a stop. It's not 30 or 40 cents, it's only 15. So entry is 315, stop is $3, and we get this spike here up to a high of just under 340. We pull back, and some traders maybe take a little profit just in this spike. We consolidate, and now we are forming the first 1 minute pullback after the fresh 5 minute breakout. So this is a little bull flag. Here's the candle, here's the pole, and here's the little flag. The first 1 minute candle to make a new high is right here. So that would be your entry, and we pop up, we pull back, and then we go through high of day all the way up to 360. Okay, so that was the first 1 minute setup. That worked. We pull back, now we consolidate, and now we're forming the second 5 minute bull flag right here. The entry is over 360, right here, right here, right here, over 360. And on this one, we pop right up to 380. We pull back for a second. Doesn't really give us a good 1 minute pullback here. I mean, it pulls back on this candle and then it just keeps going. So not a very good pullback. It pretty much just keeps going without us, and then up to a high of $4. A little pullback over to the 20 moving average, and although you could have gotten in here for the break over 4, the risk is getting higher because look at how extended we are on the 5 minute time frame, and we're not touching our 9 moving average. So it starts to get a little extended, and that's when we start to see 1 doji, 2 doji, a topping tail, and a reversal. So that's the risk. All right. Here's PRGN, and this is the 5 minute time frame. So all of a sudden, the stock squeezes up. There's the flagpole, and then 1, 2, 3 candles that are red of pullback, a fourth one, and now here's this green doji, and this green candle breaks the high of this one. So your entry would be the top of this candle. Your stop would be the low, which means your entry is right around 147 and your stop is 140. So your stop makes sense, only 7 cents. And then you get in 47, 40, 48, whatever it might be. This pops up, it drops down, doesn't stop you out, and then it really goes on the next candle. Now this is one of those ones where I'm not sure why it kind of had this candle of hesitation on the apex point. It's a little strange, but then it popped up. Second pullback, 1, 2, 3 red candles. First candle to make a new high would be right here, entry at 164. Stop is the low of this candle, which is about 160. So it's a 4-cent stop. Profit target is high of day. And you squeeze not just through high of day, but all the way up to 189 and just under $2. And then you get the pullback. So does that make sense what this pattern looks like? The candle spiking up, the pullback is a buying opportunity. You're buying the dip down to the 9 moving average, and your entry is the first candle to make a new high. The reason I like this pattern so much is because the entry is so obvious. When you look at these charts, if I ask you where's the entry, you look at the first candle to make the new high, and you're like, yep, it's right there. And where's my stop? It's either right here or it's 20 cents, whichever one's closer. Now, this is PRGN, the 5-minute chart we were just looking at, and this is the 1-minute chart side by side. So look at right here where I have this little blue circle. We actually got a micro 1-minute pullback. That one little red candle, the stock hit our scanner, it pulled back for a second. First candle to make a new high is your entry. That's that little micro pullback. So we pop up, we rest for a second, and then right away traders come back in and we squeeze back up higher. That micro pullback is a buying opportunity. It's riskier because it's on the 1-minute chart and it's a very small pullback. It doesn't give you a lot of time, but it is a place where I get into these stocks and where you will probably as well once you build up your skill. Obviously, the 5-minute time frame is easier because you've got 5, 10, 15, 20, 25, 30, 30, 40 minutes to watch this setting up for this entry right here. Whereas on this one, you had 1 minute and 2 minutes where it's hitting the scanner, and now you've got to get in. But if you did that, you'd be in this right around 125, and you'd be able to ride it all the way up to 160. That's a nice 20% plus move right out of the gates. We get the pullback, and note here, this is the first candle to make the new high on the 5-minute. And this is what it looked like on the 1-minute. The flag pole, 1 candle pullback, 2 candles of pullback, first candle to make a new high is a 1-minute flag pattern. So this is a zoomed in version of this. Really, it's the same pattern. The spike up, the 2 candles of pullback, and that's your entry, squeezing up. Note that you're right close to your 20 moving average support. On this breakout, the second 5-minute breakout, we did not get a very clean 1-minute pullback. It just kind of squeezed right up. So sometimes you'll miss that 1-minute pullback. The second pullback, Joe, to answer your question, this is actually a 1, 2, 3, 4 pattern on the 1-minute time frame. And we'll cover that pattern more in a moment, but what it means is you get a pullback, which is 0.1. 0.2 is the high. 0.3 is where you make a low that's usually equal to 0.1. So 0.1 and 3 are the same. 1, pop to 2, low to 3. Sorry, 1 and 3 are the same. And then 4 is when you break over the high of 0.2 and squeeze through high of day. But I'll show you the breakdown of that pattern in a moment. Here's another one, HMNY. We squeeze up from $2 all the way up to 6. We pull back 1, 2, 3, 4 candles. Your entry is right here. First candle to make a new high from like 550 all the way up to 6. 650, 7, 725. That's a huge move, almost 2 points. Another pullback of a false break right here. This was the first candle to make a new high, and we popped from 7 all the way up to like 750, and then we dropped back down. So this was one of those ones where you get out quickly when it comes back down to your entry point. If you get in at 7, pops up to 750 and then comes back down to 7, you get out at 7. You get out break even, bail out or breakout mentality. And maybe in that you would have had time to sell half for a profit. And then here, first candle, second try at it. Now this is okay that this is the second try because we're at the 9 moving average support. We've got support here. So this is worth getting in for the second try. You're in at 7, you go to 750, to 8, 850, 9, 950, all the way up to $10. That's 3 points on a breakout. Imagine taking that with 5,000 shares. That's easily a $10,000, $12,000 winner. All right. Now, this is HMNY on the 5-minute that we were just looking at, and here's the 1-minute. So this is zooming in on the 1-minute to see what's happening inside these 5-minute candles. This blue circle here shows me a micro pullback. We popped up, we went sideways for 1, 2, 3 candles. It's a little hard to see because it's so zoomed out. First candle to make a new high, we squeezed from 250 all the way up to 3, 350 to 4, 450 to 5, 550. That's a really nice move. That's 100% move in about 5 candles. That's 5 minutes, 100%. And that would be buying a 1-minute bull flag, which is a micro pullback. So again, you didn't have a lot of time to get in this trade. This is a trade that more experienced traders who have been doing this for a while would see the setup forming and jump right in. You only had basically 3 minutes to prepare, but that was a good entry right there. Greg, to answer your question, on the first 5-minute flag, isn't the green candle after the red candle higher? You mean this green one right here, or the green candle after the red one? Right here, right here. Yes, this one is higher. This green candle, let's see. Are you referring to this right here, right around $7? or are you referring to this one? Because this one right here, this green candle, I wouldn't have bought this little pullback because we were so extended. This is one of those times where you had a little bull flag on the 1 minute chart, but the 5 minute was so extended, there was a lot of risk. So you could have gotten in it, but it's higher risk. So maybe a little, yes, it is kind of a micro pullback on the 5 minute time frame because it's like you have this candle that's pulling back, but we're way above our 9 moving average. We're kind of floating up here in the middle of nowhere. So then we pull back. I think this candle and this candle are about the same high. This one pulls back, and then this green candle is your entry as it breaks the high of this candle. We squeeze up, we pull back. This candle makes a new high. It's a false break. We pull back. This one works and squeezes up. But this is going to show, again, that if you want to trade just the 5 minute setup, that's the easiest one to trade because you've got so much time to let this form. I mean, you've basically got, 30 minutes of this going sideways, either going up and then going sideways for you to think about your entry. So getting in right here at 550, you've had a lot of time to think about it. Whereas this one, you had to jump in fast. You had to make a quick decision, jump in. But you can see if you're able to, the reward there was awesome. I mean, 100%. So you pull back. You pop up here and note here on the first 5 minute breakout, which is right here, right in this candle, we pop up and we pull back under $6, under the whole dollar. Okay, remember when we talk about half dollar and whole dollar breakouts, it's not uncommon to see these patterns forming just under whole dollars, or to see times where we break over a whole dollar, can't hold, and then pull back below it. So this consolidation under 6 is where more traders would look to accumulate a position who missed the 5 minute setup. They see it pop up and they say, okay, I'll buy the first 1 minute pullback. So you've got the flagpole, the 1, 2, 3 candles sideways, first one to make a new high, gives us the break over 6 and the squeeze up to just under 7. Now in this case, even the second 1 minute pullback ended up working. We pull back again here and we squeeze up higher. So this one was really, really strong. I mean, it was exceptionally strong. You pull back here, and now notice this. On the 1 minute time frame, we're below the 20 moving average, right here. So actually, as this squeezed up and got ready to make a new high, we had just come from below it to above it, which to me, even though this was the right 5 minute setup to enter at 7, the stock had just dropped all the way down to like 630 and then kind of squeezed back up, pulled back, dropped below. So it started to get a little extended here and a little choppy. But again, if you step back and refer to the 5 minute time frame, it looks fairly good. And the time frame is the one that will be the most well respected. Now look at this stock. This went from $1.50 up to $6.79, and it happened pretty fast. In one candle, it went from $1.50 all the way to $4, and then it continued slowly up to $6.79. So obviously a huge move. So how would I have traded this type of stock? When I saw this hitting the scanners and squeezing up, I immediately recognized this is a stock with a history of running. So where can I get in? I could potentially take an entry at a half dollar or a whole dollar and simply set a 10-cent stop. So if I'm getting in at 250, my stop is 240. If I'm getting in at 3, my stop is 290. Because I know as this stock breaks over half dollars and whole dollars, we're getting that added push. We're breaking over resistance. So as long as we don't come back down below it, I can hold. This is a high risk strategy because you're not waiting for a pullback. So it's basically the highest risk. If you took that type of trade, you could have gotten in this really early. The only time I would just simply jump into a stock at a half dollar or a whole dollar is when it hits the high day scanner. I immediately identify it as a former runner with a great daily chart, recent history of making a big move. I hear someone say it has news today, so I know there's a catalyst. It has a low float, and we have massive volume coming into it. That's the only time. It needs to meet all 6 criteria in order for me to just jump in without waiting for a pullback. If I jump in without waiting for a pullback, I need to immediately have that 20-cent, 10-cent stop, whichever one I choose based on my share size. Because I know that I'm buying a stock extended and it could turn around quickly and come back down. Now, if I waited for the first 1 minute pullback, that would be, kind of in this area here, although it's not, I mean, this is kind of the best one that you got around 450, 455, right in this area. First candle to make a new high, squeezing up to 550, little pullback under the $0.50, up to 570, little pullback under 550, back over that level. So you see that kind of battle here at the $0.50. And then again at the whole dollar, this candle kind of taps it, pulls back, we pop over it, pull back around 650, and we get over that level. So this is one that would have been especially hard to trade because it never gave us a clean 5-minute setup, which is true. This is kind of like difficulty level of 10 out of 10 in terms of day trading. I mean, this is one of the harder stocks to try to day trade because it doesn't give you a safe entry. You kind of had to anticipate what you thought it would do based on how the stock has traded in the past. So having said that, this is high risk. The reward potential is good, but given the risk, this may be the type of setup that, as a beginner trader, you simply decide to sit on the sidelines and watch it trade, and then in the future, as you get more experience, you could trade it on your own. This is a 1-minute setup right out of the gates. The stock starts squeezing up. We pull back. First 1-minute candle to make a new high. The bull flag entry. Right? So this looks the same as our 5-minute pattern. It just happens to be on the 1-minute time frame right out of the gates. And I'll always buy the first 1-minute pullback when it looks really clean like this one does. This right here shows a stock that's squeezed up from $3 all the way up to $4.25. And as we popped up here, you can see the move up, the 5-minute pullback, the entry at $3.79, and the squeeze higher. And note what you have right here is being the first 1-minute pullback after the fresh 5-minute breakout. So this pullback right here was at 423 and between 423 and like 415. So that was right inside this candle. We popped up, we pulled back for a second, and that was an opportunity for fresh traders to come in for the next leg up. Traders who missed that first move, they come in for the next move. Which is fine. This one just does happen to be a little on the extended side. So if I got into this, I would recognize that my risk was a little higher than this safe 5-minute setup. So here's another 5-minute setup. You've got 3 green candles in a row, and then 1, 2, 3, 4 candles pulling back. None of these candles broke the high of the previous candle. This was unbroken. This was not broken. This was not broken. And then this one was broken as this green candle squeezed up. Entry here, stop at the low. We're at our 9 moving average support. So with an entry here at like 320, we get the move up towards 350, over the $0.50, up to 356, 357. So that was a good setup right there. This is one that was a little higher priced. I think the risk on this was certainly higher, but note, this is a stock that was on our gap scanner. It was gapping up with news. We popped up to 37.50, which is a $0.50. We pulled back, and as we broke over the $0.50, we popped all the way up to 38, 50 cents. And then consolidating under the whole dollar, 38, once, twice, and then finally we break over it and we pop up to 38.50. This is the type of stock that kind of moves in these 50-cent increments. So if you can get into the right spot, you can capture 50 cents pretty quickly. Again, though, this is to show that you can find these patterns on higher price ranges, but a lower price range will typically be safer, because look in this one candle how it dropped from 38 all the way back down to 37.50. It's a 50-cent drop before it ran up 50 cents. So that's what can get you stopped out and what can give you some unnecessary losses. This is a bull flag breakout, a bull trap, a false breakout. So right here, and this is important to be able to identify these, you have this false break where this candle made a new high over 220. We made the new high, we broke 220, and then we came back down and pulled back. So why did that happen? What does the 5-minute chart tell us? Well, we had 4 or 5 green candles in a row, and then we had 1 candle of pullback and 2 candles of pullback. So we didn't pull back for a long time, and we weren't as close to our 9 moving average as we might like, although, we were just a little above it. But what's more concerning is that when you look at the 1-minute time frame, and you guys know that, whenever I'm trading, I'm looking at both the 1-minute and the time and the 5-minute. I'm not looking at just one. I'm looking at both of them. So when I pull up the stock that I traded today, PRAN, which we'll look at in detail in a few minutes, that's the 5-minute chart right there, and this is the 1-minute right beside it. So I'm watching these side by side. So when I see this 5-minute setup on this one here, I'm looking at the 1-minute, and I notice look at how sharply this pulled back from 220 all the way down to like 185. That was a sharp pullback with a good amount of volume on the sell-off. And then all of a sudden we surge back up to 220. Looking at the 1-minute chart, does getting in there at 220 feel safe? We're a little extended off of our moving average. We just came up from a drop down to 195. To me, this seems like it's not quite right. It just kind of dropped down a little too much and then popped up. It feels too extended. So for that reason, I would probably not want to get in it. And it happened to be a false breakout. It popped up and then it dropped down again. Now, this right here was another bull trap and a false breakout. Now, we were watching this for the break over 250, the $0.50. Okay, so you can see it consolidating here. We pop up, we pull back. We've got our 5-minute setup. We've got 1 candle and 2 candles. So my entry was right here, 235. Excuse me, the first candle to make a new high, 235. All right, low of this pullback is 220. So 15-cent stop, entry at 235 on this green candle. We get the volume spike. We pop up 15 cents to a high of 250. And what do you notice about the level 2 right here that's a problem? Who notices a problem? We have a 60,000 share seller. That's a big seller. That's a problem. That guy is putting a ceiling on it, right? You guys see it, the huge wall there. Now, it's not impossible that we could break over that level if we see a lot of buying. You see all of a sudden it go to 59, 58, 57, 56, and then suddenly 46, 36, 26, 17, 15, 14, 13, 12, 11, 10, 9, 8, 7, 6, and that's when I would jump in to add for the break over 250 because I'm seeing that seller getting accumulated. And I can watch all of the orders going through here, and I can see this number getting smaller and smaller. But in this case, we popped up to here. We have 12,000 shares of volume, and I could tell people weren't buying here. 290, 200 shares, people weren't buying. And so I said, you know what? I got in this at 235. We've got 244 on the bid. I'm getting out. And I just got out. I bailed. Breakout or bailout. So I got a small win. It wasn't as much as I wanted, but that was the right move because we ended up coming all the way back down. So a false break right here at the top. This right here on HTGM shows us another one of those 5-minute charts where we're a little bit extended. We squeeze up here, we get to a high, we pull back for kind of one candle. The high of day candle is a red candle, which is, I don't really love that, but we kind of pull back there. But then I'm watching the 1-minute time frame and I'm kind of like, you know what? It sort of looks like it's curling here. And if it can get over this dime, this kind of white dotted line of 260, I bet we could get back to high a day. That's what I was thinking. And so I jumped in there at 260. Now this entry is based on, this is a little tricky because the first 5-minute candle to make a new high was over 62. So why did I get in at 60? I got in at 60 because I saw us pop once to 60 and pull back, and twice to 60 and pull back. And so I thought, you know what, if we can break over that level that we've had a little resistance at, we're almost definitely going to break 62, right? We got to break over 60, then 62 is no problem, and then we're just looking right back to high a day. So I'm going to take a stab here at 60 with a stop at the low of that candle or 10 cents, whichever one's closer. So that's the entry, and you got the move here from 260 all the way up to $3, which was a really solid trade. This is another false breakout here. This candle squeezed up, this stock squeezed up from 340 all the way to 420. And then we have two candles of pullback. Now, what do you notice about this first candle to make a new high that might give us, or what do you notice about this setup that might give us a little bit of a red flag? It's really extended off of our 9 moving average. Number one, and number two, we have 3 doji candles in a row. So what do doji candles tell us? They're candles of indecision, right? So when you see a stock this extended and you're seeing 3 candles of indecision, it feels a little risky. It feels like maybe there's, just not quite as much strength on the buying side because it keeps popping up and dropping down and popping up and dropping down, or dropping up and popping back up, but it's not showing the strength I'm looking for. First candle to make a new high is here. We make the new high, but we don't hit our first target, which is high of day. We break up to 420 and then we roll over. So if I was in right here and we popped up and we came back down, I would stop out, break even. Now, if I had to take a loss, I would take a loss, but I would get out quickly. I wouldn't continue to hold as this drops from 420 all the way down to 360. You get out quickly. Now look at this one. This is another false breakout. So you've got this stock that squeezes from $1 all the way up to 263. Big move. We pull back. First 5-minute candle to make a new high ends up working. A little extended, but we go from 240 all the way up to $3. So, nice 20% pop there. We pull back, and now this, which looks like a better flag pattern because it's had more time to consolidate, ended up not working. The first candle to make a new high was an entry at 280, a stop at the low of this red candle here. So entry was here, stop was here. We popped up from 280 all the way up to $3. We made new highs, and then suddenly we came back down. So as we came back down, I would take some profit because this was a winning trade, and then stop out the rest, break even. So unfortunately, it's not one of those ones that continued to go higher, just kind of popped up and then rolled over. This right here shows another bull trap, a false breakout. So this kind of was a choppy stock already, kind of popped up and faded, popped up and faded, popped up and faded, making new highs and not working. Finally, we got a pretty nice squeeze here up to 270, pullback, 2 candles of pullback, first candle to make a new high with an entry here at 265, stop at the low, and in this one we squeeze up and then we just quickly pull back. Not for any rhyme or reason, but note that we were not able to make new highs. We didn't hit our first target. So as we squeezed up, there's a good chance that we would have seen either some big sellers on the level 2, or we just would have quickly noticed, look, I got into this trade looking for, decent follow through, and we just didn't see the squeeze we were looking for. So break out or bail out, get out of the way. Maybe there weren't a lot of traders, that were interested in this for whatever reason. Here's another one. 5-minute setup. We pull back, but again, we're a little extended off our 9 moving average. We pull back. This candle makes a new high by like 5 cents and drops back down. So when I look at my statistics, I know that I'm right, 68 to 72% of the time. So these are trades that I might take thinking they look decent, and they just end up rolling over. It doesn't necessarily mean that you did anything wrong. I wouldn't say taking this trade right for the first 5-minute candle to make a new high was a bad setup. Yes, you had a doji here, but this was a pullback, so I might be okay. Just didn't work out. They're not all going to work. It's just important that you take the best quality setups because those ones work the best, and you keep tight stops, so when they don't work, you stop out quickly. Robert, your question there, if you go back and watch class, let's see, it's in class number 4 that I break down the types of candlesticks. So dojis, long body candles, topping tails, etc. That's part 1 of class 4. Okay, so there's that. A bull trap, a premature breakout is a trap for beginners. So this right here, and you can just kind of barely see it, it made a new high by like 2 pennies on this red doji. But note, this was fairly extended off of our 9 moving average. This wasn't a solid, clean pullback. Traders jumped in, it popped up by 1 penny, and look at how in this candle we squeezed up and then came all the way down. That's those traders rushing into the trade and then rushing back out and getting stopped out for a loss. That's that kind of emotional trading, the greed and then the fear. It's a really good example of the way the market can sort of whip around and shake out beginner traders. Now, if I step out of this for 1 second, we can look at a few, let's look at this trade from today on PRAN, P-R-A-N. Okay, so on this stock today, this was hitting our high day scanners and it was squeezing up. Actually, I'll bring this in just a little bit more. It was hitting the high day scanners and squeezing up. The high here was, let's see, 350. We hit 350 exactly, and then we pulled back. So what we had here was a micro pullback on the 1 minute chart, because this was just a 1 minute candle that didn't make a new high. So as I watched the next candle, I said, okay, as soon as the next candle breaks over 344, that little candle is going to be essentially a pullback candle. The next one makes a new high. That's my entry. So I said, okay, I'm going to get in this at 344. And that's exactly what I did. You know what? So did a lot of other traders. This thing popped up to 365. So from 344 to 365, I'm immediately up 20 cents. And then it continued. In this candle, we popped all the way up to 389. So continuation, squeezing higher. Now, this ended up going up to a high of $4, which meant on this 1 minute micro pullback, it went from 344 to a high of 410. So, you know, that's a 20% move in 1, 2, 3, 4 minutes. And that was an opportunity today for me to make over $6,000. Now, if I had waited for the first 5-minute pullback, well, by the time we got it, it wasn't until down here. I would have missed the entire first part of the move. So, you know, I jumped in this fairly quickly, knowing 2 things. Number 1, this is a stock with a history of making a big move as recently as 2 days ago. Made a huge move 2 days ago. Yesterday was the resting day, and then today was the first day on the daily chart to make a new high. This was almost, it wasn't quite a daily bull flag, because usually you want the flag to be up high and not down low, but it was the first candle to make a new high, and so that's why I jumped in there. And Sam, when I say hitting the scanner, I mean showing up on my high day momentum scanner, you know, as a stock that meets my criteria and is hitting new highs. So this right here was a small micro 1 minute pullback. Now let's look at a couple of others here. Let's see, I need to just pull up my logs to kind of remember some of the stocks that we were trading the last few days. All right, so we had, let's see, that one wasn't super good. So we had, well, let's actually look at PRAN from 2 days ago. So the day that PRAN made this big move was back here, where it went from $3 all the way up to $4.60. It's a pretty big move, right? So let's zoom back and look at the 1 minute chart. If you waited for a 5-minute pullback on it, you didn't get it. By the time it happened, we ended up with a false breakout. We popped up to a high of $4, it popped up 10 cents and then failed. I got in at $3.90 and I made 5 cents on it. You know, it didn't hold that level, it didn't work. Now, on the 1 minute time frame, note that this stock squeezed up from, let's see, we did a micro pullback right here at 316. The same thing we did today at 344. See how that you have that mini little green candle? It's like a little teeny rest candle after a spike. A rest candle after a spike is a momentary pullback. A momentary pullback where traders look at that and they say, okay, I'll get in at the high of that candle, which is 316, and I'll set my stop at the low of that candle, which is 304. That's a 12-cent stop. That's your trigger candle. Your entry is the high, your stop is the low, and from there we went up to 360. And then we squeezed up even higher and just continued. So this pulled back here for a little 1 minute setup in this area, 367. A little 1 minute pullback here. These ones weren't as good because they were a little more extended by this time, but advanced traders might go into them thinking, you know what, I'll go in, break out or bail out. I'll get in, it'll either pop up 10 cents immediately, or if it doesn't, I'll just get out break even. But you have to be able to trade fast if you're doing that type of trading on this setup or this setup because they're so extended. All right, so this one here you can see was this almost the same exact setup as today. We pop up, we pull back for one moment. First candle to make a new high is the entry. Okay, so let's look at another one. We had CBIO last week. We had a couple trades on that one. But I think I'm going to check APOP. I know we had talked about that one a couple times. I'm trying to remember which of these stocks we talked about last week. I know I showed you some 1 minute pullbacks, little micro pullbacks last week. Let's see, was this one? Yep, this was a small one right here. This was a really small one at 1225. We popped up to a high of 1225. We pulled back for a second, and then we squeezed up to 1350. Again, higher risk there. So these 1 minute pullbacks that are really, really small, I call them micro pullbacks, and I only would trade a micro pullback on the 1 minute time frame. And the reason I would only trade it on the 1 minute time frame is because I only want to trade it when the stock is just going crazy. I mean, when it's just totally squeezing up super, super strength. By the time it's happening on the 5 minute, you already have a lot more time that's passed, and usually traders are going to be a little bit calmer, a little bit more rational, and they're going to say, no, this is too extended. But when you see it in a 1 minute, you know that that kind of feeding frenzy is like underway, where traders are just like, I want to jump into this, I want to get a piece of the action, and so they just hop right in. So this is GBR. This one gave us a couple of trades. You have, let's see, I don't know why it does this thing. It's like I want to move the candle and it just is drawing a new one. It's really kind of weird. So let's see. Whatever. We'll just leave it there for now. So this one squeezed up here really quickly. You have a kind of a micro pullback here at 312 because it's the first candle that just rested for a moment. So some traders would have gotten in at 312 for the move here up to 336, which would have been fine. It would have been a winner. Here's a more defined pullback. This is more of a proper pullback that, excuse me, whether we saw it on the 1 minute or the 5 minute, we would be like, yes, this looks decent. First candle to make a new high is the spot I'd be watching, which would be over 316 right here. As soon as this candle breaks the new high, we move up to 345. This is the first 1 minute pullback after this fresh breakout, which some traders would go for, from 345 up over the $0.50 to 365. Now we're starting to get a little too extended. I don't know if I would really want to trade that, but you can see it continues higher. So again, on this one, you've got your micro pullback, which is this candle right in here, and that's the high risk entry. And then you have this slightly safer pullback on the 1 minute chart. It's still on the 1 minute chart, and you know you're still in the context of a 5 minute chart, which at this point is starting to get fairly extended. At the same time, you look at the daily chart and you recognize this is a stock with a history of making big moves. It's a strong daily. It's squeezing, lots of volume. There are traders who are not going to let this pull back. They're not going to sit and wait for it to pull back. They're going to get in as soon as they see an opportunity, and this is an opportunity right in here. So these are 1 minute pullback and 5 minute pullback setups. So when I'm talking about the pullback, I'm talking about essentially the bull flag and then the small micro pullback. I remember, as I said at the beginning, the inverse is a bear flag. So a stock that sells off quickly, pops up for one moment of a little green candle, and then sells off again. Or here in this case, sells off, pops up for one little green candle, and then sells off. And then pops up for a couple little green candles, and then sells off. But remember that these are stocks that you'll have to find shares available to borrow, number one. And number two, they may be on short sale restriction, especially after they drop 10%, because, I mean, that's just the way the short sale restriction works. 10% down, SSR goes on, and that means you can only short it when it's popping up. So that makes it more difficult to get an entry. But just so you know, you can, if you want to, apply this pattern to the short side. This is a higher price stock, sell off, couple candles up, right? And then the first candle to make the new low is your entry as we sell off more. So these bull flags and flat top breakouts, or these bull flags and bear flags can be traded to the long side or the short side to stocks of any price range. Stocks above $10, you should very, very rarely trade them on the 1 minute chart. You'll usually want to focus on the 5 minute time frame because it's going to be more well respected. But again, remember, not a lot of people day trade $100 stocks. So the group of people that will be buying these types of patterns, it's going to be smaller, which means the breakout won't be as big or with as much volume. So inevitably, traders look for the area of the market where the opportunities will be stronger, where there'll be just bigger opportunities. This right here, bull flag breakdown pattern, the sell-off, the pop back up, kind of a little bit of a messy one, but the first candle to make a new low, first, and then it pops up a little more, and then second starts to roll over a little bit better. Note that we're kind of coming up to the moving averages and then rolling over and selling off. So although the bull flag pattern is my favorite, and it's the one that I can show you the most examples of, the second pattern that we will see from time to time is the flat top breakout pattern. All right, so I'll jump back in here. The flat top breakout, unlike a bull flag, doesn't really pull back. You have 1, 2, 3 taps at the same price. So we keep tapping resistance, and eventually we keep hitting it, and we're usually going to break through it. So the flat top breakout looks for 3 taps at a resistance point, whether they're 3 candles in a row or it's 1 candle and then a couple candles down, second one, couple candles down, and a third one. So it sometimes can be a bull flag that failed and is now just sort of a longer flat top breakout with resistance at this one level. When we break that resistance point, that price, that's the apex of this pattern, that's the entry. Stop is either the low of the last 5-minute candle, if you're trading the 5-minute chart, the low of the last 1 minute if you're trading the 1-minute chart, or 10 to 15 cents depending on your risk. So the flat top breakout and the flat bottom breakdown is the inverse. The flat top breakout has the following characteristics. Usually 3+ candles moving up sharply, just like a bull flag, although sometimes it might just be 1. A couple candles of sideways consolidation that can be red or green, slightly below the high of the squeeze. We want to see continued consolidation that will ultimately rest on the support of the 9 moving average, and the entry point is the first 5-minute candle to break over high of day, knowing that high of day has already been tested once, twice, and 3 times before that. Here's an example. This is on the 5-minute time frame. We tapped high of day at 57 once, twice, 3 times, and 4 times. Now remember, this has 2 setups. The first is that this pattern, regardless of the price, is a flat top breakout. But the second is that this is a pattern occurring right underneath a whole dollar. Now, although I'm not a big fan of trading stocks in the $57 price range, this is a stock that was moving up quickly with lots of volume. It was a stock in play. So for traders with larger accounts, it would have been worth looking at. Entry at 57 for the first candle to make a new high. Stop at the low of the red candle, which is about 56.80, so 20 cents. Target would be not high of day, but simply you're risking 20 cents. Your target is times 2, which is 40 cents. Your target is 57.40. And it can be a little harder to know whether or not these stocks will hit your target, but when you look at it, you say, well, how much has this stock moved today? And you see it's already moved well over $1 today. So that tells you it's the type of stock that if it breaks out, could probably move 50 cents or $1. And we did move all the way up to $58 per share. Now this is a little bit of a different example. Again, we're right at the whole dollar of 55, but look at how long we consolidated sideways. I mean, this was literally like an hour of sideways consolidation, right under 55. We kept tapping it once and twice, kind of pulled back, came up again, pulled back, just underneath that whole dollar. Finally, when we broke that level of 55, lots of volume came in for the break. Long period of consolidation, we finally break. Lots of traders had the opportunity to see this forming and get their orders ready. We break 55, we go up to 55.20, 20 cents, and then we go up to 55.40. So after all of that waiting, we only made like 25 cents per share. And it's a $55 stock. So the percentage on that is tiny, it's minuscule, which again is why this isn't really an ideal set or an ideal trade. This isn't the type of trade I'm going to look for every single day. I'd prefer to see this on a $5.50 stock than a $55 stock. But in any case, the flat pattern, the flat top breakout pattern is still the same, and it's a decent setup. Now, I want to note that you don't want to see a big U shape in the taps. So when you hit the high here and then you pull all the way back and come back up, you have this U shape, this sort of empty space. That's not good because this is very extended between the first tap, the pullback, and the second tap. You want tight consolidation the way you have here because that helps you establish a very low level of risk. Your risk on this was probably only about 5 cents. This was 54.80 down here, which would have been 20 cents. So your stop is probably maybe 10 cents at most. So you got your profit loss ratio on this of risking 10 cents to make 20. It just wasn't the most exciting trade. You wouldn't make $500 on this unless you took 5,000 shares, which means you put $250,000 cash into this trade to buy it. So, today I made $6,000 with a position that cost probably around, let's see, I could tell you exactly. I got in, cost $54,000, and I made $5,000. So, to put in $250,000 to only make $500, it's kind of not worth it. But again, the pattern looks good, which is why I'm showing it to you. Now here's a pattern on a lower price stock, flat top, again, right under the whole dollar. We came up to resistance once, we consolidate underneath it, consolidating at the 9 moving average. Finally, we break over that level, but in this case, again, we only went from 8 up to 8.10. So, the good news is that your stop, entry at 795 in anticipation of the break, since we kind of had, I guess, resistance at 95. You had a tight stop, and it gave you almost an immediate winner, but the profit on it was sort of minimal. Now, this is what I mean here by that U shape. You pop up, you pull way back, and when you come back up here, you've got a U shape. But this was a good entry for a bull flag. Even though it was kind of a longer bull flag, we pulled back once, twice, 1, 2, 3, 4, 5, 6 candles of pullback. The first candle to make a new high here gave us a nice move. So first we have the bull flag, but it can't break new highs. So sometimes when a bull flag fails to break new highs, it'll end up consolidating into a flat top breakout. Tap once, taps twice, taps 3 times, and then maybe for the 4th time, we go for a trade. Here's another example of the flat top breakout pattern. You pop up to 65 and you hit it once, twice, 3 times, 4 times, consolidating again here under that level. So we know when we break over 65, there's a good chance we'll see volume. That's exactly what we see on this candle. Big volume coming in for the break over 65, and we spike up to a high of 65.95. So a nice 5% move right there, 5% in one trade. A little pullback, first candle to make a new high on this pullback gets bought up, and we squeeze up over $7. But just like bull flags, flat top breakouts will give you the bull trap, where Traders jump into it, we squeeze up, and then we roll over hard and we get that whip. So you see here, we broke over $40, the whole dollar, after tapping once, twice, three, four times. We finally break over that level. We go up to a high of, it was like 450 too. I mean, it was a big move, 50 cents up and then 50 cents down. So that's a lot of swings, squeezing up and then coming back down. And that type of swing is going to be more common with the higher price stocks, but in terms of that amount of range. But still, we see these false breakouts from time to time on the lower price ones as well. So to answer your question, does the bull flag need to be testing high of day as well? A proper bull flag will pull back and not only test high of day, it'll break through high of day. So that candle that resolves will be breaking through and making new highs. Here's a flat bottom breakdown. We sell off and we tap at the low of 55.20 once, twice, kind of three times, and then finally we break through it and sell off. From 55.20 all the way down to 52. I mean, that's a 3-point sell-off. It was substantial. It was not a bad trade. But again, you had to put a lot of money into it. This is kind of a messy chart, lots of indicators on here, which again shows you when you have all these indicators on your charts, it really does kind of make it more difficult to see what's important. But in any case, you've got the flat bottom support at 50.75. We tapped it once, twice, three times, consolidating right above the level, and then finally breaking it and selling off to the lows. So AJ, to answer your question on how to avoid bull traps, you can't really avoid them. The best thing you can do is whenever you have 10, 15, 20 cents of profit, sell half. Take half off the table because you never know when it's going to sell off. That way you take profit anytime you're up 20, 30 cents. And then if it does come back down, you just get out break even. You know, you just take the rest out of the trade. Beyond that, there's not a lot you can do. These fake outs will happen. Those are the trades that you lose on. And if they happen 30% of the time, then that means you're right 70% of the time and you're doing pretty well. So I think that that's about the best you can do, really. I mean, even for me, after years of trading, that's about the best I can do, 70%. So Jim, to answer your question there with respect to flat top breakouts or breakdowns, how does one understand the difference between the upside breakout of the stock hitting resistance and simply rolling over because it can't break out? So you do have that issue where you keep hitting that resistance level, or in this case, you keep hitting a support level and then popping up, support and then popping up. So when you sell it right here, it's like you're shorting it right at the support level. Is it going to pop up again? Well, you rest assured feeling that because it's consolidated at the lows so many times, it keeps testing, keeps testing, keeps testing. Eventually, it will break that level because it's so weak that it's just continuing to test it. So, that's sort of what you figure, and then you measure your risk against a tight 10 to 15 cent stop. The apex point is always that resistance line, right? That exact price. So again, it makes it fairly easy to see the proper entry. And to answer your question about how to calculate when to take your profit whenever you get into a trade, well, I know the apex point is my entry. So if the apex point is $4, my entry is 4, my stop is $3.90. That's a 10-cent stop. So when I'm up 20 cents, I will have hit my 2-to-1 profit loss ratio. So when I see the stock is up 20 cents, I'm ready to take profit. I mean, if I see any indicator of weakness, I'll definitely take profit. If it looks incredibly strong, it's a home run stock that meets all 6 of my criteria, I may hold it a little longer, take a little more risk, kind of leave it on the table, thinking maybe it'll get to 450, maybe it'll go to 5, maybe it'll go to 550, 6. I mean, if it's that type of setup, I'll try to give it the room. But, if it's the type that I think might only pop to 425 and then sell off, I'll be faster to take my profit. And I'll be able to understand that based on how well the stock meets my criteria for being an A quality setup and what the price action looks like as soon as I get in. If it shows right away a lot of hidden sellers, a lot of resistance, not moving very much, then I'll be more cautious and more likely to get out quickly. Okay, so pattern number 3 is the moving average pullback. Now, a moving average pullback is actually a lot like a bull flag and can exactly be a bull flag. The difference is that there may have been a candle that made a new high and faked us out. So we may have had a false break in there. We may have had one or two false breaks, and we're now just sort of waiting for that consolidation period at support. And if we hold support for a long enough time without breaking it, oftentimes the stocks will start to curl up and make that move higher. So that's what we sort of call as a moving average pullback. A bull flag is usually more well defined as being 3 or maybe 4 candles of pullback. And when you sort of start to exceed that many candles, that's when it kind of starts to look like just a regular moving average pullback that no longer looks like a clean bull flag. So a moving average pullback has the following characteristics. Again, 1, 2, 3 candles of sharp upward momentum, followed by 2 or more candles of consolidation above the 9 moving average. And this may start out, as I said, as a bull flag or a flat top breakout, but then ends up having a false break or just simply not resolving and taking longer to consolidate. A perfect 5-minute pullback pulls back to the 9 EMA on the 5-minute chart. Now, the challenge with this setup is that the entry point is not always clear because there's not always an apex point. We already had the first candle make a new high and it failed. We may have had the flat top breakout, but it failed. So now it's just kind of looking at the chart and wanting to see some sign of curling where we're getting some volume, it's starting to move up slowly, and usually it means taking a starter position with like a 20-cent stop and then adding as we kind of start to break critical levels like half dollars or whole dollars. But the truth is it's not as well defined. This right here on BOSC is both a bull flag and a moving average pullback, right? Because we pull back to the 9 moving average, which is 100% true, but it's also the first candle to make a new high. So this one kind of happens to be both. This pullback here, is kind of also a little bit of a bull flag, pull back to the moving average. This shows you 1-minute versus 5-minute trading, which on this one right here, you have the first breakout, and then this first 1-minute pullback ended up being a little 1-minute bull flag as we squeezed higher. So we broke out of the 5-minute time frame here, we pulled back, and then moved higher. So this one, that last one was a 5-minute. Sorry, that last one was a bull flag and a moving average pullback. This one is a moving average pullback. It's a bull flag right here, but then it broke. I mean, it basically did a kind of like a false breakout. It popped up, and then we had this red candle that was just sort of sideways for 15 minutes. When you get into a bull flag, you expect it to go back to high day immediately. So we kind of just went sideways, but we were holding the support of our moving average. And that's why it sort of turns into this moving average pullback. It's sort of a bull flag, then it didn't really work right away, and then all of a sudden it worked here. And that's what I mean where it's sort of hard to time the entry because it's like, why did this work here and not here on the first candle to make a new high? And I don't really know the answer to that. But when you see a stock that has made a big range, from $2 up to $5, you watch the first pullback and you think that that's going to be an opportunity. In this case, it popped up, pulled back, sideways, and then it started to go. So where would your entry point have been? Probably a 1-minute pullback right around here as we started to open up. So look at this right here. This was where we started to break out on this one candle. We kind of popped up, we pulled back. This is where we popped up and actually we're making new highs. We pulled back. These 2 candles and this green candle was our rest candle. That was an entry point, a 1-minute micro pullback. And here was a second 1-minute micro pullback. So we had 2 micro pullbacks that give us a place to establish an entry with a stop at the low of that candle. The gap between these candles is because of a is because of a halt. The stock squeezed up, was halted on circuit breaker, opened higher, and sold off. squeezed up, was halted again on circuit breaker right here, opened higher, squeezed up, sold off, squeezed up, sold off. So this is a stock that was halting on circuit breakers because it was moving so quickly. All right, this is another one, moving average pullback. You can see in this case, you kind of got a bull flag here. Pullback popped up, but we didn't make new highs. We hit kind of resistance at high of day and then sold off. Consolidating, consolidating, consolidating. And then we kind of just start to curl a little higher. And you see how we kind of pop up here and pull back for a second. This is a 5-minute chart, but you can see how there was a little bit of resistance under this dotted line of 440. And you knew high of day was 450. So you figure, well, if I was short this stock, where would I cover? Well, probably if it breaks over 440, it's not going to look good for a short, and definitely not over 450. So that's where you might think, well, I'll take a starter over 440 with a stop at like 425 or 430. Give it a little room. And then I'll double over high of day, looking for traders to cover their short positions and for a squeeze. And that's exactly what happened. Starts to pop over 440, continues over 450, and squeezes up towards just under $5. So on this one, a nice 10% squeeze. Here's a moving average pullback that, again, is not really a flat top breakout because it was sort of dipping a little lower, a little lower, a little lower. This is Tesla, a $250 stock, but you can see it's sideways, and then all of a sudden, for whatever reason, we get the break, and now it starts to open up, and we squeeze higher. First 5-minute pullback is respected, right? 5-minute bull flag here, and we go even higher. This was a squeeze from $246 a share to $256 a share. So a pretty big move for sure. Now, to answer your question, sometimes I do find myself on a stock like this holding through the pullback. I try to avoid this as much as possible. So that means if I get in, somewhere like right here for the first 5-minute candle to make a new high and it pops up to here, when it comes back down to here, I really don't want to be holding it. Sometimes I get a little stubborn, and even though I know I should sell, I hold it because I guess I've seen this happen so many times. It just, is such a bummer to sell it down here on the support of your 9 moving average, knowing that this might coil and move higher. So it's not a good habit for me to do that. Really, it's not. I should just bail out or break out or bail out. I should just get out of the trade if it's not holding these levels and it doesn't do what I thought it would do. But sometimes when I get in and it drops immediately, I'll hold to let this flag form. But I definitely wouldn't recommend that. I want to do that less and less as much as I can. Jim, to answer your question there, when you're in the trade and the current candle is green, but pulling back from its high, what keeps you in the trade for the next candle instead of bailing out? This is, and that's kind of a continuation of the question that was just asked. It depends on a couple things. Number one, it depends on the 5-minute setup. If I'm trading a 5-minute setup and it's a green candle that starts to come red and we're close to the 9 moving average, I may decide, okay, well, I guess I'll just hold this sideways for a little bit because I'm right around break even, or I'm only down a little bit, and it's still a good setup. It's still the right type of stock to trade. It still meets, all of my criteria, my 5 or 6 criteria for having home run potential. Yes, I'm down a little bit on it right now, but it's a bull flag. It's a momentum stock. I think this pullback will get bought up. But that's an educated guess, and sometimes I'm wrong. I was wrong the other day on that stock I was holding that, pulled back, consolidated, and then dropped. And my loss ended up being twice as big because I held it too long. So, it's the right thing to do is probably to simply take the loss and then look to get back in if a pattern forms again. When I just sort of sit there and hold the setup, I'm being stubborn and I'm not wanting to take a loss on the trade, thinking, this is such a strong stock, it's going to move back up. And that's not really the right mindset to be in. I mean, if I'm going to be honest, it's being stubborn. So, I know I do that from time to time, and it usually happens when I get into a stock too high. That's usually when it happens. I buy the stock too high, and then when it pulls back down to support, I'm like, well, I don't want to sell on support. I mean, it's pulling back to the 9 moving average. This is a place where traders who are waiting for the first pullback will get in. Granted, I'm the guy who bought it way at the top of this candle wick. So let's say I bought like at the top of this red candle wick, thinking it was just going to squeeze higher, and then suddenly it pulls back down to 8. I'm like, well, but here's the moving average, and it'll probably get bought up because it's such a strong stock, and that may all be true, but at the same time, I'm holding a red position and kind of hoping for an outcome, and hope is not a good strategy to have. It's not really a strategy at all. So one of the things that I've said to myself is to avoid getting into that situation, I need to trade smaller size when I'm trading a 1-minute stock that's already extended on the 5-minute chart. Because if it's extended on the 5-minute chart and it does a false breakout and quickly puts me into the red 20 cents, and I've got 10,000 shares and I'm down 2 grand, it's going to be harder for me to hit the sell button. So trade smaller size on 1-minute setups that are extended. That way, if I am down 20 cents, it's not as much of a dollar loss. It's that big dollar loss that starts to get me more emotional and more stubborn. So that's the first thing. And then, the second thing is to make sure I'm trading proper 1-minute setups and not just chasing into squeezes. So I'll just back out of this for 1 second and show you one of the trades I took on Friday that I was really disappointed with my trade on this particular stock, because I got just I don't know what encouraged me. It was so funny because right before the market opened, I was saying to everyone, look guys, I don't think I like this setup. It's really extended. I need to wait for a good 1-minute setup, and I don't think one's going to form, so probably just have to sit tight on it. That's what I was saying. Let's see, where's the entry here? Go back. Sorry, this is yesterday. Okay, so this is like so ridiculous. So the stock is just squeezing up, and there wasn't really anything on my watch list that looked good. And I think I sort of started to feel like this is, it's squeezing up. This looks like it's the one that's just going to go, to 950 and then to 10 and 1050 and 11. So where did I get in? I got in for a break over the whole dollar at 9.95. I was anticipating a break over whole dollar, which, in the context of this right here, could have worked, and we could have gone all the way up to 1050, the next half dollar, and then 11, 11.50, 12. And given the strength we've had in the market the last week or so with these types of stocks, with APOP and CBIO, et cetera, it made sense that that could happen. But what did I not do? I didn't wait for a 1-minute rest candle. I didn't wait for that micro pullback. I just jumped in. Now, I showed you that example on that stock earlier. I can't remember the symbol, that basically just squeezed up from like $2 to $6, just squeezing. And I said, well, you could get in these at the half dollar and the whole dollar, but the risk is high. Well, that's what I did on this one, and the risk was high. I got in at 95, and the worst thing was that I didn't wait for a micro pullback. So where was my stop? Well, I mean, usually you set your stop at the low of the last candle, which, in this case was $9. Look what happened in this candle. We dropped all the way down to 873, and it happened fast. It was a big loss, and it was really discouraging because that was 2 minutes into the day. It's 9:32, and I'm hitting, a big loss. It's Friday. I mean, nobody likes to have that happen, and it was my own fault because I didn't wait for a micro pullback, and I jumped in at the whole dollar, and I didn't size down as much as I should have. I used my hotkey, and when I use my hotkey, I'm buying 2,500 shares. So I didn't have time to adjust the hotkey. I just pressed it, jumped in. Next thing you know, I was down 50 cents, and I was down $1,000. I mean, it was like that. And by the time I hit the bailout button, the loss was over 2 grand. And I ended up making on my next trade $2,800. So I made back, everything I lost on that trade, but it was a completely unnecessary loss. This is a lesson on the importance of waiting for a 1 minute pullback before you take a trade. If you want to jump in a stock that's moving fast, I understand that, but you have to wait for a 1 minute pullback. You can't just jump into it as it's squeezing. I mean, and I say this even as I contradict myself, because before I was mentioning that stock, OPTT, I think it was, that went from $2 to $10 or $8. So yes, there are times where you can, you can get in at whole dollars, but the problem is if you're going to do that, you have to understand the risk is higher, and so you have to bail out immediately. And the problem is sometimes these move so fast, you're just like a deer in the headlights. And so unfortunately, I mismanaged my risk on this one. I didn't sell fast enough. I got emotional. I got stubborn. I just held it too long. It was stupid. It was a bad trade. And so, the 30% of the time or the 35% of the time I'm wrong is a combination of good setups just not working and me being human and just making stupid mistakes, which, is going to happen to all of us from time to time. I mean, you can't avoid it 100%, but if you can become aware of it, then hopefully the time in between stupid mistakes can get bigger and bigger and bigger. So anyways, a little bit of a tangent there as I wanted to just show you that setup. So let's see. And again, we'll do Q&A at the end of this class, but I just wanted to kind of briefly answer a couple of questions there that were pertaining specifically to these types of setups. Okay, so did that answer your question, Jim? I hope. And I think I did go on a little bit of a tangent, but I'm trying to think of the last stock I held through a long pullback, and yeah, I can't think of the last one. I mean, this one that I held through a long pullback and it ended up actually working. But generally speaking, if I take trades where I'm managing my risk, I can avoid that situation. So it's avoidable. It's avoidable to get yourself into the spot where you feel like you have to hold because, the setup is still valid on the 5-minute time frame. You never really want to be in a trade where the setup is still valid on a 5-minute time frame, but you're down like $3,000 on a 1-minute chart. Because if you did that, you kind of mismanaged your risk. You got too heavy on a chart that was extended on the 5-minute. So the times to be most aggressive are going to be on stocks like, Pran today, PRAN, where I got in this at 344, which, was me being aggressive, but at the same time, this really made sense because my stop was only about 15 cents away. I mean, kind of right at this 20 moving average. We were sort of right there at support. So in at 344, that was a good setup. Some of the other charts that we've looked at and that we'll continue to look at, we'll show you. Let's see. Let me grab one of them here. A good pullback setup. This one, for instance. Wait, that's not the one. Sorry. Where was it? I just had it. Oh, here we go. This one, for instance. This is the type where you can I'll feel confident getting really aggressive on my share size because I'm buying it right off support. So my stop is tight on both the well, again, this isn't the right one because this is a 1-minute chart. But let's say this was the 5-minute. If this was the 5-minute, I would feel really confident on this one. And I think you know what I mean. So that type of safe pullback is the place that I'll be especially aggressive because I can look at it and say, look, I'm not getting in this where it's super extended on the 5-minute time frame. So this is a great example. Let's say I got in HMNY up here at $6. It pops up to 610 and then suddenly drops down to 5. With 10,000 shares, I could be down $10,000. Only to see later in the day it hits $10. I mean, geez, that's, $30,000 of profit. So, in this one, I could have said, well, I'll hold it sideways until it hits the 9 moving average support because as long as it's holding above the 9, it's still a strong stock from a just technical analysis perspective, which is true. But you don't want to be in a trade where it still looks good on the 5-minute chart and you're holding this down 10 grand. You got too heavy on the 1-minute. However, getting in this area, risking, 10 grand is a much better risk reward ratio, because if it works, your stop is here, your profit target for 1-to-1 would be here, that would be 10,000 profit. You're risking 10,000 profit here, 20,000's here, 30,000's there, 35,000's here. That's something that you can manage your risk on with that 2-to-1, 3-to-1 ratio, but not when you get in on a really extended 1-minute setup. So just a reminder that, when you trade 1-minute setups, you want to make sure as much as possible that you're adjusting your risk, because 5-minute setups are the best. So 5 minutes are the ones I'm going to be most aggressive on, in probably 8 or 9 out of 10 times. Let's see. So let me jump forward here, back into our moving averages. So, and Lewis, to answer your question, is holding always bad if that stock does meet all your criteria? The problem is that when you hold, it tells you that, when you're holding a stock that's red, you got in it too high. So you have a bad entry. So the problem is holding is an emotional kind of thing to do, so it's not good. And then the second problem is that, you bought a stock that you bought it too high. DRYS, this is another one of those moving average pullbacks where you got kind of the first bull flag here. We popped up, we pulled back, we kind of popped up, pulled back, popped up, pulled back. It wasn't really like it wasn't clean. And then all of a sudden we kind of curled out of this level, and note that we're right underneath the $0.50 of 950. We break over 950 and all of a sudden, boom, we're right back to 10. We're back to high a day, and we go from 10 to 1050 to 11, 1150, 12, 1250, halted on a circuit breaker, opens higher, squeezes to 1139, pulls back, second 5-minute setup extended, but it squeezes all the way to 1560 from 950. That's a huge move. So these are the types of trades you want to get into. You want to get into a trade with low risk that's had a pullback. So you're buying the dip, and then selling through the squeeze. This is the smart setup. If you miss this trade and then you bought it way up here, that's risky. Yes, this 5-minute setup, this did pull back and make a squeeze higher, and it did go from 1380 to 1560, so that's 2 points. But when you buy way up here, what happens if it drops down to 12? I mean, you could lose 2 points. So this was the safe entry. This was the low risk entry. If you traded it up here, hopefully you had a lot of profit from this one, that this was kind of like you could afford to take a little bit of risk, but you scaled back your risk with smaller position sizes. So the inverse of the moving average pullback is the moving average pop, where the stock pops up to its moving average, consolidates, and then rolls over and sells off. Now, again, the challenge, of course, with these is short sale restriction, finding shares available to borrow. But if you just see the market better from the short side, you can trade the inverse of all of these patterns. I think that the long side of these patterns have better resolution because more traders in the market have a long bias. So that's just my opinion, though. Number 4, the 1, 2, 3, 4 pattern, also known as the ABCD pattern. So this is when this can start as a bull flag that fails, like a moving average pullback. So that's why you first need to understand the bull flag. That's like kind of the core component of almost all of these patterns, and some of them extend on. So we have the move up, the pullback. First candle to make a new high goes up, but we don't make new highs. We hit that level and then we pull back. We sell off, and what's important ideally is that on this drop, we don't want to break the low of point number 1. So we want to be kind of consolidating but moving up at the same time. It's okay if we double bottom at the same low. It's okay if you break it by a little bit, but you don't really want to see it a lot lower, because then it just kind of seems like you're trending down. You kind of want to see it down, up, down, not as low. And then this is sort of like a second bull flag in a way, but the entry point really is looking for a break over the high. This is your apex. If you break over this level, that tells us that there's strength, and then of course the next target is a break a high a day, and you want to see a move higher. Okay, so this is point 1, point 2, point 3, point 4. And Ilio makes a good point here. He says, remember guys, find your niche. And that's 100% true. If you can find one pattern to trade successfully, and of course I recommend the bull flag, you can be a profitable trader. You just have to sit and wait for that pattern to come around. Now, if you add a couple more patterns to the tool belt, there's more opportunities to trade. But again, first things first, master one strategy. You're not trying to be a jack of all trades. You want to be a master of one. So I definitely want you to focus primarily on the bull flag pattern. It's the one I'm going to have the most examples of from live trading. We'll be talking about it a ton in class 6. But at the same time, I want you to be aware of these patterns. And if they interest you more, then that's fine too. So the 1, 2, 3, 4 pattern has the following characteristics. 3+ candles green moving up sharply, followed by 2 or more candles of consolidation above the 9 EMA. Then a first 5-minute candle to make a new high that does not break high of day. So the high of this burst is 0.2. Then a second pullback to the 9 EMA, which forms 0.3. The entry is when the stock moves back up for the second time and breaks over 0.2, becoming 0.3. So the entry is when we break over 0.2, high here, which is number 4. Okay, becomes number 4. This consolidation should occur above the 9 EMA as usual. Entry point, break of point number 2. Stop will usually be 20 cents max. So this is kind of what it looks like on the chart. Move up, point 1 is the pullback, point 2. Ideally, we may be entering this right here thinking it's a bull flag breakout, but when it fails, we get out of the trade, and then we let it pull back to point 3, which is the fail, and we say, well, it's either going to sell off and drop back down here, or it's going to hold up, and if it does, I can look to get back in over 0.2. So my entry would be over 0.2, target is high a day, and then a squeeze through high of day. So this is an example on a chart. This stock squeezed up, and you can see the 1 minute is kind of choppy. It's all over the place. Even the 5 minute's not ideal. But we have the 5-minute squeeze, and then we pull back. And we've got 1, 2, 3 candles of pullback on the 5-minute time frame. So your 5-minute entry is the first 5-minute candle to make a new high, which is right around 5:45. As you look at this pattern forming, you could say, well, I want to buy this simply because it's the first 5-minute candle to make a new high. But as you look at the 1 minute, you can see that there's also a different pattern forming inside the 5-minute pattern. So it's kind of interesting how this works. This is a bull flag on the 5-minute, and on the 1 minute is a 1, 2, 3, 4 pattern. Point 1, point 2, point 3, and point 4. So your entry is right here, which is at 0.2. Now, as you saw this forming, you saw we sort of double bottomed here. 1 and 3 are about the same price. As we pop back up, you're watching the high of this price. Not just because it's the high of the last 5-minute candle, which it happens to be, but also because it's the high of 0.2. So that's your entry, 545, which is just below the $0.50. Your stop is 10 cents, maybe 20 at the most. You don't want to stop out all the way at the low of this pullback because that's too far away. So your entry here is 545, and we squeeze up to 620. Not bad, right? That's 10% move right out of that entry. So the 5-minute setup works great. The 1 minute has a corresponding setup, so you basically have multiple time frames lining up, both giving you the thumbs up. Okay, and this is also right alongside a $0.50 break, which is strong as well. Here's another one. Stock squeezes up out of the gates and pulls back. It's a little extended. The price is a little on the high side on the 5-minute chart. The price is high, period. It's a little extended on the 5-minute chart. And this is a topping tail doji, so it sort of squeezed up and then pulled back sharply. Then it pops up to 0.2, pulls back to number 3, and notice how we're kind of curling here at the moving average. So you could get in this at 2 places. One, you could get in a little early in anticipation at 12.50 for the $0.50 break, thinking that as soon as we break over 12.50 and we break over that psychological resistance, there's a good chance we'll break over $2. We'll break over point 0.2. And at the same time, the first 5-minute candle will be making a new high. And that's exactly what happened. So if you got in at 12.50, you're getting in at the $0.50 to anticipate the breakout. If you wait for the breakout, you're getting in at at 12.60 or something like that, 12.65. And either way, it was a winner with a squeeze up to 14.50. So 12.50 to 13, to 13.50 to 14, to 14.50. A solid trade. First 5-minute candle to make a new high on the 5-minute setup, and a 1-minute 1, 2, 3, 4 pattern. So again, 2 patterns there, both lining up. Now this is a 1, 2, 3 pattern on the 5-minute time frame, which is a really unusual pattern. This is not one that you'll see me trade very often. This is a stock that's not at high of day. It actually had a high here of $7 and then sold off and is now coming back up. Now, this was a stock to keep on watch because it was a gapping stock. It had a lot of volume today. It was definitely something people were watching, and this was setting up for a potential move from red to green. This line is the red to green line. So as we break above this, we go from being red on the day to green, and anyone who's short is going to be forced to cover. So we kind of pop up here to 750, we pull back to 730, we pop back up, we pull back, and we know as we break over point 0.2, there's a good chance we'll then break over 750, and we're kind of going to change direction. So not the cleanest setup. We kind of, honestly, this is not the cleanest setup, and it's not one that you'll see me trade on a very regular basis in this context, being red on the day. But you can see we broke over this level, and then we had the first 5-minute pullback here, and this one ended up working out pretty well too. So a couple different entries. One could have been over 0.2. One could have simply been over the high of day, which was 750. Or by the time it got to 750, you probably would have said, look, this 5 minutes too extended. I'll wait for the first pullback. So this might have been the most logical place, the first pullback after the 1, 2, 3, 4 setup. All right. Again, a little more risk on that one, not my favorite. This one, though, looks pretty good. Okay, this was HMNY, which we watched before. Pullback, high. So this was the bull flag that was a false breakout. Would have entered here for the breakout, thinking it was going to be a real one. Ended up faking me out, so I would have stopped out, probably with a little bit of profit because it was a good move. We pull back here, and now I'm watching the high of this level. If we can break over the high of this level and then hit high of day, that's the spot I'm really going to be watching. We break over that 725, we go up to 8, 850, and up to 9. So really solid setup there. 1, 2, 3, 4. Another one here, same stock, different day. We pop up to $9, we pull back. We pop up to a high here of 850, we pull back, and we kind of consolidate here. And this is sort of a combination of a 9 moving average pullback and that sort of 1, 2, 3, 4 setup, but not the cleanest. And you have to recognize that I try to show you really good chart examples, but some of them will be a little less than ideal. And every chart pattern is slightly different, even though there's a lot of similarities that cross over. Okay, so yeah, this one you got the squeeze up to here. The first 5-minute candle to make a new high, a false breakout, didn't make it even close to back to high a day, which is not surprising considering how these two candles were really bright red. We pull back up to here, 850, pull back up, back down, kind of a 9 moving average pullback, and then all of a sudden, as we break over that $0.50 of 850, we squeeze back up, and we know once we break over this apex point, high a day is the target, right? And that's kind of showing you also some of the stuff we talked about with those gaps and windows on the daily chart. When we break over a level like this, the next logical place, you look to the left and up, and that's high a day of $9. So breaking over 850 was the critical spot on this stock. It was just strange that it had to break over, once, twice, 3 times before the 4th time it finally worked. But, that's just the way it is sometimes. Okay, so remember, guys, that the patterns that I'm showing you and that we've looked at today, these are only patterns. They are not a strategy. In class 6, we'll be going over strategy development, which is when we apply these patterns to the right type of stocks to trade, and we start creating rules that we trade by. The price range, the time of day we trade, the type of news we trade, et cetera, et cetera. So when you look for these patterns and you look for examples of them on stocks, what you should do is you should look at the stocks with the highest relative volume. So let me pull up my scanner here for a second. We'll look at the relative volume leader scanner. So this scanner here, I'll put it over the side. Relative volume leaders. So these are the types of stocks that had high volume today that we should be looking at for these chart patterns. So NVCR, for instance. NVCR today, did we have any good patterns on this one? This one squeezed up in pre-market and then sold off. So as soon as the bell rang, it was a weak stock. We never really got a strong bullish pattern. It was pretty weak all day. AKTX. AKTX, interesting that suddenly in the middle of the day, this spiked up. I would have to think there was news on this, but I would have to double check to be sure. So let's look at this because this is kind of interesting. So we have a 5-minute squeeze from 10 all the way up to 1250. So my question, the first question in my mind is, was there a 1-minute pullback that would have given me an opportunity to get in this somewhere inside this move from $10 to $12? Because I can see that I certainly could have gotten in this up in this area here. I could have gotten in, this is a little micro pullback on the 5-minute, a little extended, but I could have gotten in there for that move higher, or I could have gotten in on this second little pullback here for the break over the whole dollar. So those are kind of the two spots I could have watched. Let's see, make that a little bit bigger. Well, whatever. So on the 1-minute time frame, this suddenly squeezed up to 1050. And it was probably, there was probably a headline on this or something, stock has news. So we squeezed up to 1060, and look at this, a 1-minute resting candle, 1-minute micro pullback. So that would be an entry. The high of that candle was 1060, the low was 1040. You're risking 20 cents. So does that look like a good entry? Looks pretty good to me. Time of day is not ideal, and the price range is just a little over 10, but it's okay. The float is low, so I'd say it's worth a try. Let's see what happens. Get in at 1060. We already know what happens. It works. So it moves up to a high of, let's see, 1149. And then here we've got another little pullback. This is under 1130, high was 1136 right here. So now we're getting a second 1-minute pullback. Although at this point, we're definitely more extended on the 5-minute chart. So, probably in this one micro pullback here, I would have had the opportunity, to make, that's, 50 cents per share. So that's pretty solid. But over 1137 right now is a possible entry. So there's a possible entry. High of day is 1149. And there you go. There's a pop up to, see, this one went to a high of 1178, and then it did a fake out all the way back down to 1112. Choppy. So showing you how continuing to trade the 1-minute setup as these get extended on the 5-minute can start to get whippy. The safest entry here was the 1-minute pullback. So, and you can see it ended up going a little higher. So anyways, AKTX, a couple good 1-minute setups. So that's the right type of stock to apply these patterns to. So you could go into this scanner, any day, look for high relative volume stocks. And these are the same scanners I have on screen share, and review them for good chart patterns. TRR, I'm not really familiar with this one. Looks like it's a buyout, so no trades on that one. ELOS, oops. Again, there's nothing really on this chart. So next one, PRAN, we know we traded that one. We had the first 1-minute micro pullback. The first 5-minute pullback on this one ended up popping up about 5 cents and then selling off. Notice this red flag. What would you say is the red flag about this 5-minute setup? There's two. One is that high of day is a doji with a topping tail. And the second is that the highest volume of the day is a red candle. Now this is above the 200 moving average on the daily, so that's okay. Um, I'm not sure where the 200 is on the 5 minute right now. I can't see it on this chart. I don't know why, um, but you know the primary issues, the doji at high of day, a little iffy on that, but the big problem is that the highest volume was red, so we didn't see strong buying volume, and that's a bit of an issue. Ended up faking out and pulling back. Tear. This one looks like it was weak today. AUXO. This one, not a lot of volume. BCLI. This one, not a lot of volume on it, and it's a 5 cent. I think no, it might not be. Just not a lot of volume though. Next one, Cool. So this one we had, you know, a little bit of a moving average pullback type of pattern here. It wasn't the cleanest because it pulled back and the first candle to make a new high was here. So, but this wasn't a good bull flag because this candle was so red. It was pulled back too much. Popped back up, sideways consolidation, started to curl up and then broke out 1680 up towards 19. CYCC, yep, I can check that one. Strong after hours. During the day, we did trade this on a 1 minute setup, but the 5 minute didn't really form that well. We pulled back, but we were too extended by this time. We had pulled back too much on these candles and high red volume on this high day candle, but I did get it on the 1 minute chart for a 1 minute micro pullback. So let's look at that. So let's see. This popped up. I was in right here. Let's see. This little candle here, we dipped down and then we moved higher. So that was a little rest candle. It was extended, but it was not a bad try. Let's see. Other one. PRNA or PNRA. Oh, Panera, higher price stock. Tesla was a higher price stock today as well, making a bit of a move. So, you know, these ones aren't going to respond as well, but it goes to show that today I was able to find a couple of micro pullbacks on the 1 minute chart, a couple of 5 minute setups, and those were enough for me to make $6,400. It's not about trading a lot, it's about looking for a few A quality setups. So this is, class 5, continuing to build your foundation as we dig deeper into the intraday chart patterns. Being a successful trader means you need a foundation. Number 1, risk management. Number 2, stock selection. Number 3, understanding strong daily charts. Number 4, understanding intraday chart patterns. Number 5, having a strategy. Class 6, I'm going to show you my strategy. All right, but right now, a few steps that you guys can take to help you trade the strongest patterns. Number 1, focus on 5-minute chart time frames or the first 1-minute micro pullback. Now, the micro pullback can take the form of a bull flag. It can take the form of a flat top. It may pull back to be more than just one red resting candle, but start to look for them. And I bet you'll notice them on the stocks that have the highest relative volume. And of course, you're in the chat room, so you guys are able to watch the stocks I'm trading every single day and hear me break down why I like them, why I traded them, what my entry was, what my stop was, etc. Only apply the chart patterns we've looked at today to stocks with high relative volume. Chart patterns on stocks with low volume are meaningless. They're only valuable and they're only indicative of a buying opportunity on stocks that meet our criteria for being stocks in play. Number 3, use the high day scanners to find stocks squeezing up and then wait for the first pullback as an opportunity for an entry. You can see the high day scanners streaming live in the chat room every day. Number 4, remember, these are only patterns, not a strategy. In class tomorrow, I'll show you, or in class 6, I'll show you the first strategy where I utilize these patterns. So for those of you who are trading in the simulator right now, sure, it's okay to start practicing trading these patterns and based on what you think are the right entries and the right stop loss points and stuff like that. But we're going to get more detailed in defining the right way to trade these. Okay, so with that, we're going to switch gears and go into the FAQ section for this chapter and answer any questions that you guys have, and I'll show you more examples, I'm sure, during the FAQs of 1-minute pullbacks, 5-minute pullbacks, bull flags, flat top breakouts, etc. All right, so we'll jump over to the FAQ section.